We're going to get into a lot of material here, and I'm going to introduce you to several things here today that some of you may not have been exposed to yet. I'm going to put a link here in the chat. That's to a workbook that you'll want to go and get. This is just going to be something that you can fill out as we go along here. It's going to get into, I'm going to cover some of the options basics. We're going to define what options are so that you can, for those that are just getting started in options, you'll be able to follow along with the examples and the different strategies or positions that we talk about here throughout the session today. So go ahead and get that workbook. We will fill that out. It is designed to be interactive, so in these little blue boxes here, you can type these in. So if I just type that in right there, you can do that. You can also print it off if you rather do that, but I'd say fill it out here and then print it off. That way the words are here. You don't have to write it out longhand. So in any case, I do believe this is being recorded, so I think that you can watch it over again. But we're going to talk about one of the major things that I want to talk to you about today is how to grow your portfolio even when the market drops. I know a lot of people are constantly calling for market tops, and the truth of it is nobody really knows. And all we can do is do what my youth pastor always told me to do, is prepare and prevent rather than repair and repent. And so we want to kind of, as investors and traders, we want to set ourselves up to prepare for adverse moves in the market rather than repent for it later on, as that oftentimes is painful. So let me just introduce you briefly to our agenda for the next 45 minutes, folks. I'll try to get us back on time here, but I'm going to give you a brief introduction. We're going to get into some options 101. I'll get into some strategies that I use to bulletproof my portfolio for when the market does head lower, and then we'll get into some Q&A. Go ahead, and if you do have questions as we go along, instead of having to remember it throughout the entire session, go ahead and put them into the chat box, folks, and I'm happy to answer those as we move forward. But I'll do that at the very end if that's okay, so that we can just kind of stay on task. So just a brief introduction of myself. This is me. When I was 16, I got my private pilot's license. I started flying when I was 13 years old and got introduced to flying as a Boy Scout, actually. I got my Eagle Scout when I was 16 and basically spent all my days at the airport after school. It was a fun way to live. I love flying and was actually going to fly. I wanted to fly for the National Guard fighter or F-16s. Didn't end up doing that. I ended up going on a mission trip to the Philippines, came back and met my wife, and we've got 4 kids now, and we are actually right now expecting our 5th. So that keeps us on our toes, keeps us very, very busy. And here's my family right now. This was just last year. We try to take a trip out to Hawaii every other year or so. But these are our 4 kids, and we've got 1 in the oven right now. So in any case, that's a little bit about me, folks. As far as the super trader, I actually been trading is a lot like flying. When I first started trading, I got the same sensations that I got when I first started flying. The excitement, the exhilaration that you get when you take off. Everybody's flown before, if not in a commercial airplane. Also kind of the fear that the effect of gravity can have on you. The fear that you could fall right out of the sky if something went wrong. I got those same sensations when I started trading, and I think that that's what really drew me into trading. Was every day was different, and it's just an exhilarating thing. And so, in any case, ended up starting the Super Trader years ago after working for several firms in this industry. I would say we're one of the fastest growing communities. Right now we have a little over 48,000 monthly users, and I've developed 3 different trading systems, and I developed these really for me. We call them monthly income, capital growth, and explosive profits. It kind of meets all risk parameters. Really consistent monthly income, long-term growth, and shorter-term explosive gains, right? And generally, I allocate my capital accordingly. With the most amount of my capital allocated to the most conservative and the least amount allocated to the most aggressive. But those are the three systems that we've developed here at the Super Trader. Since 2007, these are the results that we've gotten. We've done fairly well, I'd say. I don't have the return on risk number for you, but I can say our average return on our account has been just over 45% annually. As you can see here, the monthly or the annual results of the S&P on the right-hand side. One thing that you can do on our website, it is thesupertrader.com. You can't forget the at the beginning of it, but you can come over here and we do all of our trades in real time. I actually analyze it in real time. You can go over here and see our real results for this year. Right now we're up just over 35% year to date across all systems here. We've got a little over an 80% win rate, and these things are important, folks. These different metrics, knowing your overall percentage win rate and also your average winner and your average loser. If you don't know these things, folks, you need to figure it out, because there's no way for you to project what your long-term results are going to be. How many of you trade options? Just type in Y for yes, N for no. How many of you trade options? Or how many of you trade? I'm sure if you don't trade options, that's fine. We're going to get into it here, and I'll give you a brief introduction to those. But how many of you trade options? Folks, if you don't know what your win rate is, if you don't know what your average reward is and your average loss is, then you have no way of knowing what your future results are going to be. Let me give you a brief little example here with an options trade that we call a vertical credit spread. Okay, a lot of people nowadays are very interested in high probability trades that have a high chance of working out for them, right? And there's nothing wrong with that, but you have to remember, folks, that there's no free lunch in the market. There's always an equal and opposite disadvantage. Wherever you find an advantage in the market, there's always an equal and opposite disadvantage, and those are the things that you need to be aware of if you're going to protect yourself against the four major risks. Okay, so one thing that we do here, we've got what we call a system development process, and one of the four major risks that we've identified is, number one, the risks of drawdowns or risk of ruin. You've got the risk of low returns, the risk of price shocks, and the risk of system death. I think that the definitions of those are fairly self-explanatory, but I will say that when it comes to any type of trading, you generally have a very high risk of low returns. We generally have a tendency to let our losers run, and we get out and cut our losses, or we get out of our winners too early. We don't let those run. So why is it important for us to understand what our these different metrics are? Why is it important to know what our win rate is, our average profit, our average loss? Well, it's because we can actually project what our long-term results are going to be when we know those types of metrics. Let me give you an example using a let's just use this. Let's say we've developed an analytics tool that you get here. We just give this to you that will allow you to visualize what your future performance could possibly be in what we call a Monte Carlo simulator. It basically takes your win rate, your reward to risk ratio, your risk per trade, and the starting balance of your account, as well as how many trades you're averaging per week. And it simulates what the portfolio should look like over the course of 200 trades. This is important because how many of us have subscribed to some person's subscription service? They give trade ideas, and they have a string of losses, and we begin to lose confidence. We begin to wonder, well, is this going to work out? Should I stick with it? You don't have any idea if you don't have any way of projecting that. And so at the end of the day, here's the problem with high probability trades. Let me take you over here to a trade that we do all the time. It's called an iron condor. An iron condor, we do this trade every single month. An iron condor is basically a trade that is, for the most part, non-directional. it works so long as the market stays within a set range. Okay, so it looks like a lot of you have options experience. I don't need to explain a lot of this stuff to you. Okay, so in any case, for this particular trade that we got into, all the position needed to do was stay within that horizontal red line, that solid red line, and that horizontal green line, that solid green line, okay, by that vertical blue line. I think it was like a 3-week-long position, okay. So in any case, the problem with this trade is that your reward is 90 cents and your risk is $4.10. Well, some people say, I'd never take a trade like that because I'm risking more than what I'm making. Well, that's not a problem if you understand how to hedge against those risks. But it is a problem. Again, remember, like I said, wherever there's an advantage, there's an equal and opposite disadvantage. So the advantage here is that I don't care if the market goes up. I don't care if it goes sideways. I don't care if it drops. It doesn't matter to me. That's my advantage. I like that. That's you know, a predictable type of thing for me. But the disadvantage here is the risk, okay? The amount of dollars I have to risk for the reward. Now, if you understand how to hedge and protect against that risk, then you're going to be okay. But here's why you need to understand why high probability trades in and of themselves aren't good enough, okay? Let's say we've got a 90-cent gain and we're risking $4.10. That means that we've got a 0.22, we'll say a 0.22 reward to risk ratio. That means that we're making 22 cents for every dollar that we're risking. Now, this particular position happens to have about a 90% probability of success. So let's go over here to our analytics tool, and we're going to go 90%. So we've got a win rate of 90%. Now, let's say we're making 22 cents on the dollar, and we're risking, say, 5% of a $100,000 portfolio. Okay? And we do this trade once a month, so I've actually got to 0.23. This is created to calculate trades per week. Okay. So we've got about a 90% win rate. Actually, statistically, it's got closer to about an 87% win rate. How many of you want your portfolio looking like any one of these 3 outcomes? How many of you want your portfolio looking like any one of those 3 outcomes right there, 4 outcomes? I know I don't. Over the course of 200 trades, you've largely gone nowhere. So the problem with high probability trades is you don't make enough for what you're risking. So that's why I say, folks, you need to be aware of what your reward to risk is and what your win rate is and how much you're risking per position, because when you know those things, then you can begin to forecast whether or not what you're doing will work long term. See, if I'm doing iron condors and this is what I'm doing, it's not going to work out very well for me. I could be deceived for quite some time, and then all of a sudden it just kind of chops sideways. So what shifts can we make? Well, can we reduce our risk? Absolutely we can. Absolutely we can. And, you know, we talk about that in our training, which is free, by the way, 100% free. Okay? You can get in and take it. But in any case, you know, for this particular trade, we identify, kind of like what Wiz talked about, Matt, he talked about, you know, a position management plan of sorts, identifying prior to ever triggering the position to get into the position, what's your loss management? What's your profit management plan? And my loss management plan, that's what reduces that risk for me so that I don't have as large of a loss. Okay. In any case, a little bit of a tangent, but very, very important that you are aware of what your win rate is, what your average reward is, what your average loss is, and then with this analytics tool, you can begin to project what your long-term results are going to be. I think I've got this tool. You guys can, you're more than welcome to download it. Believe I've got it here ready for you. Yeah, I do. Here you go. Doesn't even require an email. You can head over there and you can download that analytics tool. And it does have directions there, instructions, kind of instructions there you can kind of mess with that. But really neat tool that allows you to forecast what your results are going to be. Some of you may have a low win rate. You may be right 60% of the time, but for every dollar you make, you're only losing 50 cents, which means you have a 1.5 reward to risk ratio. So at the end of the day, how do I know if my win rate is good enough? How do I know if my win rate is good enough if I don't have the ability to measure these things? This tool will allow you to do that. So go get that tool, folks. You don't need to do it right now, but you can scroll up and get it later on. Fantastic tool that we've developed here that allows you to forecast what your long-term results will look like with any given win rate. Some people say, well, man, you need to have a high win rate. You need to have a 2.5 reward to risk ratio. I say you need to have a balance. See, you've got banks, like a Wells Fargo, who issue loans to highly qualified people, right? And then you've got payday loans who issue loans to people that probably aren't very qualified. They've got a high risk of default. And so a payday loan will have a lower win rate, meaning that every loan they issue, they may have a 30% win rate. I don't know what the numbers are. Whereas a Wells Fargo may have an 87% win rate. At the end of the day, the difference here is your risk to reward ratio. How many dollars are you making compared to what you're losing? Think about a payday loan. They're charging, what, thousands and thousands of percent interest, right? So they make up for a low win rate by having a high reward to risk ratio. So it's a healthy balance of those things. So, some of the best traders, retail traders that we know over the turtles, had an incredibly low win rate, something like 40%, meaning that 6 out of every 10 trades they got into were wrong. But they had a very high reward to risk ratio, meaning that for every dollar they made, they were only losing like 10 cents. Okay? So they made a lot of money when they were right. And so you've got to find that healthy balance, folks, and this is what we call a system. You've got to stick to some metric that allows you to see consistent long-term results. I can't have a 40% win rate and only be making $1.50 for every $1 I'm losing, because my outcome's not going to be very good, right? Not going to be very good. So, in any case, I've gone. I didn't even plan on getting into that tool, but we did it anyways. So, either case, folks, those are our results. One thing that you need to do, folks, in your trading is you need to identify the market type that we're in. All right. Now, we've identified and we categorize different market types in 6 different micro market types: bull quiet, bull volatile, sideways quiet, sideways volatile, bear quiet, and bear volatile. Right now, we're in a sideways volatile market, and the 3 different systems that we've developed. Again, I'll pull up our system development process. Our 3 different systems that we've developed are designed to work. They're designed to work where one system will work in any market type. So when one system's not working great, we have always another way that we can trade that works in the current market type that we're in. Okay. So in any case, right now we're in a sideways volatile market. So our really aggressive, 2-week-long trend trades, they're not working that great. So we don't do a whole lot of them. Right now we're not in a bullish market. Right now we're in a sideways volatile market. And so our monthly income trades and our capital growth trades are working really well. So what I want to get into here today, folks, are a couple of ways that you can get into this market and start to participate without having to worry about whether or not this is going to be the top or not. Okay, you can take a screenshot of this. This is the kind of the systematic process that we follow. We call it trade. Target your trends. This is how you identify trends, recognize patterns. I'm not going to get into it here, folks, for sake of time, as we did get cut short. So options 101. This is where you're going to want to pull up that the little worksheet that you've got. Options basics, and we're going to fill this out. So whenever you hear somebody refer to I'm long or I'm short, that all that means is they bought something or they sold something. Okay. Now if I'm long stock, depending on what stock I'm long, if I'm long, all that means is buy. Now if I'm long the S&P, it means I bought the S&P, and that's generally a bullish thing. But if I'm long puts, I bought puts, which is a bearish instrument. So don't associate long with bullish or bearish. If somebody says I'm long the market, generally that means that they're bullish. Okay, but you know, in a very dictionary type definition, the term long literally means buy, short means sell. Now, depending on the instrument that you're longing or shorting, or depends on whether or not you're bullish or bearish. So you've got 4 different types of options. Okay, you've got long calls, short calls, long puts, and short puts, meaning that we can buy calls, we can short calls, we can buy puts, and we can short puts. Okay, and again, I'm seeing your questions, folks. We'll get to those here at the end. Please put them in as we go so you don't lose track of your questions. Long calls, so whenever we buy call options, or whenever we buy any options, we have rights. Okay, options are very simple in the fact that they give you options, they give you choices, they give you the ability to make certain choices. Okay, so options are exactly what they are, that they give you options. So whenever you buy an option, you have a right. Whenever you sell options, you have obligations. Okay, just like the grocery store. If you buy groceries, you have the right to get your groceries. If you buy car insurance, you have the right to get your car fixed if you get in an accident. If you sell car insurance, you've got the obligation to fix that car. Okay, so same thing with selling options. I have obligations when I sell options. I have rights when I buy options. So let's talk about the right that is associated with buying calls. I have the right to buy the stock at a set price within a set time frame. Again, you'll see examples of this here in just a moment. When I sell call options, I'm selling to somebody that's buying. If he has the right to buy, I must have the obligation to sell. I've got the obligation to sell the stock at a set price within a set time frame. You're drinking out of a water hose here, folks. So it'll make a lot more sense here in an example. So just bear with me if this is over your head, but print this off, hang it up, and it'll help you. Whenever I buy puts, whenever I'm long puts, I have the right to put the stock onto somebody else or sell the stock. Oops, I wrote down put. I have the right to sell the stock at a set price within a set time frame. Okay? And whenever I sell puts, I have the obligation to buy the stock at a set price within a set time frame. Okay? So that's just kind of just a brief overview of what the rights and obligations of options. If you don't have that workbook, you know, or if you weren't able to fill this out, I do have one that is already filled out here that you can get. Let me see here. I will send that over to you so you don't have to go through even the headache of filling this out. Oh, let's see here. Okay, there's the completed workbook in the chat. Okay. All right, so let's go ahead and get into some examples. Folks, I want you to put in some stocks. We're going to get really open here. Give me something that you've lost a lot of money on. Give me a stock that just really hurt you, or somebody that you know got hurt. Okay, and we're going to talk about how we can protect against those types of things from happening. Okay. Thanks, Rob. So tell me, folks, what are some stocks that Kay says Osur, O-S-U-R. Rum says TVIX. Here, let me pull up my account here, and we will look at some of these. Did anybody see Netflix? Netflix got just hammered on poor earnings. Okay, so we've got OSUR. Now, I want to have something that does have options. So a little bit light volume on OSUR. Let's take a look at TVIX. Oh yeah, you would have gotten, yeah, you've got contango in your VIX instruments, and you know, again, you want to buy volatility when it's really low. But let's see here. Yeah, TVIX, I didn't think it had options. And it says Valiant. Perfect. Okay, so Valiant would be a pretty good example. NA, do you remember when you bought or what time period you're talking about? We could pick any one of these. I mean, we could pick it, you know, we got in right here and then boom, it plummeted. I mean, took a 50% hit right there. Let's do that. I mean, let's use this as an example, folks. You know, let's come in here and, you know, I mean, look at this. You talk about Elliott wave, you talk about fibs, you talk about all this stuff, and you've got over 100% retracement here. And, you know, a lot of people are thinking, you know, this may be a good opportunity to buy, right? You're starting to rise a little bit here, maybe a good opportunity. But let's say you just, you know, you got into Valiant here at, I don't know, what day is this? We'll say the March the 9th of 2016. March the 9th of 2016. So we're going to go over here, VRX, March the 9th of 2016. We're going to go back. This is what we call think back on the Thinkorswim platform. This allows me to go back and get actual prices from that day. So we're going to go back to March the 9th of 2016. Okay. And we're going to start off just really easy here, folks. We're going to take an example here. We're going to have case study number 1, all right? Case study number 1. We're going to say portfolio value. We're going to say there's a $100,000 portfolio, okay? And so we're going to say ticker symbol here is VRX, all right? And the only thing that we're going to do here is we're going to go and buy the stock. Now, you know, a lot of us have these rules that we've either, you know, put on ourselves or we've heard off of from talking heads, but, you know, they'll say something to the effect of, I'm not going to risk more than 5%, right? And that's also something that this analytics tool will allow you to see, you know, are you risking too little based on your reward to risk ratio and your win rate? Could you risk a little bit more? Are you risking too much? You know, who knows? Unless you have a tool like this, download this tool, okay? We're trying to change the industry, and if you don't have these types of information, you have no idea if you're about to walk off a cliff or not, okay? So download that tool. But how much should I risk? You know, that's a question that everybody kind of argues about. I say systematize it and risk what your analytics tool suggests that you can risk. But I also say, you know, you have to do what you feel comfortable with, right? So let's come in here and let's say, just for this particular example, we're going to buy the stock. So we're going to long the stock on that day. This was on March the 9th. And I'm just going to come in here and I'm going to be a little bit outrageous. I'm going to say you bought 1,000 shares of this stock. Okay, so just bear with me. A lot of you are like, no way, Nick, I would never do that in a million years. And I'm here to tell you that by the end of our conversation, you just may. Oh, nope, didn't want that. Orientation, there we go. Okay, so I just took a screenshot of us buying 1,000 shares of the stock. So we're buying it at $66.86, right? Crazy. You'd never buy 1,000 shares of this stock if you've got a $100,000 portfolio. How many would squirm and have a terrible time sleeping at night buying $66,000 worth of a pharmaceutical company on a $100,000 portfolio using 66% of your account? How many people would have a problem with that? Say aye. I'm sure everybody's shouting in their office or their buildings. Okay, you should. Right? Yeah, you should have a problem with that. Okay, very, very uncomfortable. But for this example, I'm going to use it. Yeah, you can put a stop up underneath it, but John, what happens if it gaps down and around your stock, right? Okay. Oh, there you go, Simon. So here's our first example. Okay, what is our maximum profit, or let's just say our risk? What's our risk? What's our max risk here? How much can we lose? How much can we lose in this example? Where can the stock go? Some people will say, well, no, there's no way it goes to zero, you know. No way it goes under 60. I'm buying at 66. No way it goes under 60, right? John says 66.8 thousand, and he is absolutely right? We've got 100% of risk, okay? 66 grand is at risk. But now, don't forget, folks, I mean, we could use a smaller number here, or we could get 100 shares. But if we had 100 shares, how much is at risk? 100%, right? 100% of what we put into this position is at risk. What's our maximum profit potential? What's our maximum profits? How much can we make? Unlimited. Simon says unlimited. He's absolutely right. So here, just on the surface of this position, we are exchanging 100% of risk of our capital in this position for unlimited upside potential. How many of you believe that this stock will go infinitely higher and you need to have 100% exposure to achieve that unlimited profit? It's not going to happen, right? I ask a lot of people all the time, you know, what is it that you're looking to do? And everyone, you know, generally the first response will be, well, duh, make money. Well, yeah, of course you're here to make money, but what are you needing to make? What are you looking to make? Well, as much as possible, right? That's not good enough of an answer because it provides no direction for targets, okay? It provides no direction for what you need to be targeting, the positions that you need to be taking based on your goals and objectives. Okay, so do I need 100% of risk to achieve unlimited upside potential? No, I don't. I don't need to risk 100% for unlimited upside potential. Okay, so let me show you just one simple way using options. We'll call this case study number 2. One simple way using options to still have unlimited upside potential. Oh, there we go. Yet not have 100% of risk in order to achieve it. So same thing, ticker symbol VRX, but all I'm going to do here is we're going to go back to our Analyze tab, and all I'm going to do is I'm going to add what we refer to, I'm going to long a put. I'm going to buy a put option. Okay, that's all I'm going to do. I'm going to buy a put option. Okay, so let me go and take a little shot of this. And then what we'll do, this will be fun, we'll fast forward through earnings and we'll see what your profit and loss would have been if you had done these different things, okay? So let me copy and paste this in here. Very simple, folks, anybody can do this. So you don't have to know when the market is going to top out. You know, you can get involved now and not worry about whether or not we're sitting at highs and we're going to roll over. So again, same thing. What did I do here? I longed the stock. Let's break down the positions that I've got. Okay, that and that. I've got 2 things now. First one I just had 1. This one's got 2. Pretty simple. I longed the stock. What did I buy the stock for? What did I buy the stock for? $66.86. Same as before. $66.86. Okay. But then I also came in here, so I had plus 1,000 shares. I also came in plus 10 VRX puts. Okay, so one contract of an option generally equals 100 shares of stock. So that's why I have 10 puts, because I've got 1,000 contract or 1,000 shares of stock. So I came in here, I long puts at the 66.50 strike, and that cost me $6.95. For our accountants in here, I will put debits in parentheses. And in just a moment, we'll get to credits that I will leave unparenthesized. Okay, so remember, folks, referring back to our workbook, whenever, all I did here was I bought a put option. So by buying a put option, I have the right to sell my stock at a set price. I have the right to sell my stock at a set price. Okay, so I have the right to sell the stock at the strike price that I have, which is $66.50. This one, we do need to put together what we call a cost basis. And all we're going to do is we're going to add the cost of our stock to the cost of our put. Okay, so we've got $66.86 plus $6.95, and that gives us a total cost of $73.81. Times that by 1,000, that means I've got, oh my goodness, Nick, you just increased the amount of money I've got into this trade. No way in a million years would I do this. Well, okay, yeah, maybe, but let's talk about it for a moment. What do you have at risk? Let's say again, we know what happened now, but let's say again, this stock plummeted down to the next day, very next day it went down to 33.01. Okay, plummets down to 33.01. You bought the stock at 66.86. Next day it went down to 33.01. Down 50% in one day, right? How much would you lose? In our first example, you would have lost about 30 grand. In our second example, you have the right to sell the stock to somebody else at $66.50. Look, some people say, well, who's going to buy my stock at $66.50? Who's going to fix your car if you get in a car accident? The person that you paid insurance to, right? So the person that you paid $6.95 to has to come in here and buy your stock. Okay, so my max risk here is the difference between my cost basis, which is $73.81, and where I can sell the stock, which is $66.50. So the most I can lose now is $7.31. $7.31 is my risk, which represents 9%. We'll say, or 10% of capital invested. So now I've got 73% of my account into this trade, but only 10% is at risk. What's my max profits? Now, I've got this right to sell even if it gaps down around. Some people will say, well, why don't you put in a stop, Nick? Well, stocks can get gapped down and around. Right? An overnight session, you can get gapped down and around it and not get stopped out. Okay? So my max profits still are unlimited. So there's one way that I can get into this and get involved and protect myself against a drop and still have unlimited upside potential. One more, really, really quick. Okay, Renee's telling me I only have 5 more minutes. Case study number 3. Same thing, $100,000 account, but this time I'm going to add one more thing, folks. One more thing. I'm going to come in here and we are going to sell a call option against this position. We're going to say we'll sell the 72.50, or we'll sell 75. All right. Okay, so now we just have 3 things here, just one more, we're done. So we'll just leave that the same. All we did here is we're selling a call option. So it's the only thing that we're adding to it. We're selling the 75 strike call, and we're getting paid $4.22. I'm just going to round that down, $4.22. We're selling the 75 strike call. Whenever I sell calls, I have the obligation to sell my stock. I have the obligation to sell the stock at 75. So if the stock goes up, I have to sell at 75. If it goes down, I get to sell at 66.50. Let's put together our cost basis. So we bought the stock at 66.86. We bought the puts at 6.95. We sold calls at 4.22. So our cost is 69.59. 69.59. So we've got $69,590 invested. Where do I have the right to sell at? I have the right to sell at 66.50. So if it drops, I can sell at 66.50. Which means all I have at risk here is $3.09. What's my max profits now? Well, I've got to sell at 75 if it pops up. My cost base is 69.59, so I've got a $5.41 upside. So now, instead of risking even 10% of my invested capital, now I'm only risking 4% of my invested capital. And I have a nice little upside that I can achieve here of 541 divided by 69.59. I've got a 7% upside potential. How many of you would complain about a 7% return in 35 days? I don't know many who would. Folks, I'm out of time, and we are completely out of time. I apologize about that. Hopefully you've taken something away from this. We do, if you, I know that there's been a lot of conversation today. Yes, there is cooks. You can go to the site. There is this stuff, but there's also, we do a trial, folks. You can head over here to thesupertrader.com/one-time-trial. Okay. And you know, we do trade ideas daily. We've got you know, all the training. We do a daily market overview, the Super 360. We do a weekly game plan session where we plan our week for the head. Any case, folks, if you have any questions, I know you guys have seen so much today. I don't even know how you can handle it, but really, I just want to come here and hopefully prepare you for you know, to help you, you know, be better prepared for this market. You can stay invested and not have to worry about the downturn. Who cares when it happens? At the end of the day, you know, stay in the side of the trend until it does. And so hopefully in some way this has been of a service to you. If you want to check out what we do, head over there to that link, thesupertrader.com/one-time-trial. And at the end of the day, you know, our membership, you can get into the training courses for free, but you don't get any trade ideas or anything like that. But either case, folks, you know, head over there. If you have any questions for me, feel free to reach out to us. You know, there's contact information all over the website, and really appreciate the time.